If you love the idea of making cash flow without doing any work, then you have to love dividends. And in this video, I'm going to be going over how you can live the dividend lifestyle, meaning how you can live off of your dividends. There are 5 ways for you to generate cash flow. You have to use your money to buy one of these 5 things. Number 1 is to generate interest cash flow. The way it works is you take your money and now you lend this out to someone else. So you take $1,000, you lend it out to your cousin Bunty. Now your cousin Bunty goes to his favorite store, Gucci probably, and now he's going to go buy himself a new wardrobe and he's going to pay you interest on the $1,000 that he borrowed from you. Number 2 is royalty cash flow. Royalties are when you go out and you write a book, and now if this book gets published and it is kind of being read by a lot of people, now you're going to get royalties every time somebody buys your book. Profit share is now kind of like Shark Tank. You go out and you find a nice company and you give them some of your money. Now this company starts to grow, and every time this company makes a profit and they distribute it to their owners, you get your share of the profit. So if you own 10% of a company and they make $100,000 profit and they distribute this $100,000, you get $10,000 as the profit share distribution. Number 4 is rent. I love talking about real estate investing. This is where you buy a property and every single month a tenant that's living in your property is going to pay you rent for living there. And then number 5 is dividends. This is purely passive. Now you can invest in a company or a fund that is going to pay you cash flow through dividends, usually every quarter. These top 4 are kind of passive. They can be passive, but they require some sort of work. Like with interest, if you want to lend your money out, yeah, you don't have to really do any work after you lend your money out, but it takes a lot of work to find somebody to lend your money out, and you have to qualify them and make sure that you get paid. If you don't get paid, now it's more work on your end. Royalties. If you want to get the royalties from selling a book, you got to write the book first, so it requires work. Profit share. Now, if you want to be a venture capitalist or a shark on Shark Tank like that, it takes a lot of work to analyze the companies, and you got to help them grow, so it requires work. Rental income. Yes, real estate can be a passive investment, but now you got to put in the work to find the property. You got to build a real estate team and you got to do all that work. Dividend cash flow is purely passive. Once you find the right company or the fund that you want to invest in, this money is going to come in and you don't got to do any work, which is why in this video, we're going to be focusing here how you can live a dividend lifestyle, meaning use the cash flow from dividends to fund your life. So that's what we're going to be talking about today. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. And a quick word from our sponsor, M1 Finance. If you are interested in investing your money, M1 Finance lets you do it automatically and passively. So if you want to learn more and see how you can do it with M1 Finance, I got the link to how you can do that in the description below. So if you want this cash flow from your investments, this passive income to cover your investments, you got to know what it's going to take. And let's assume, for the sake of this example, that you want $40,000 a year to cover your expenses. $40,000 a year is just over $3,300 a month. So you want to make $3,300 a month in cash flow from your investments. Now we've got to figure out how to do that through dividends. Essentially what you got to do is you got to understand the different types of income there are. So there's active income and then there is passive income. What you're going to do is you go to work every single day. And this is the active income that you're earning. This is your earned income. You go to work, you get a paycheck, you want to take some of this money and you want to put it towards your passive income, towards your passive investments, things that are going to pay you with cash flow. In this case, we're talking about dividends. So every time you get paid, you want to put a little bit of your paycheck, the more the better, towards your passive income. And now in this video, I'm going to be going over how and how much to get this $40,000 a year or $3,300 a month. That way now your dividend income can fund your actual lifestyle. The way dividends work, and I'm going to get more into this in just a minute, but you can take your money and you can invest it into a company like McDonald's. Now, McDonald's is a very established company, and every year they have a whole bunch of profit, a bunch of cash sitting in their bank account. Now, when they have this cash in their bank account, there's 3 things they can do with this cash. They can save some of this cash for emergencies, they can put this cash back into their business so they can grow faster, or they can give this cash back to their investors, people like you. So what they do in this case is they say, well, we have so much cash in our bank account that we have no better use for this cash in our own company, so we're just gonna give it away to our shareholders in the form of a dividend. So every year, or actually 3 times a year, McDonald's sends out a check to all the shareholders, people like you, people who own their stock, and this is what a dividend is. So a dividend in this case is every 3 months you get cash cash deposited into your bank account because McDonald's has paid you a dividend. It's completely passive. You don't have to do any work to flip burgers or any of that. If you own the right shares, now these companies will pay you with this cash flow. The reason why dividend investing can be so attractive to some people is because you don't need a ton of money to start investing in dividend stocks. Like you can start investing in dividend stocks for as little as $100. You can compare that to investing in real estate where you're not going to buy a property for $100. So if you want to start investing in dividend stocks, start generating this cash flow from dividends, it's a much lower barrier to entry. You can start with $100 a month or whatever money you have, and you can slowly let this compound. And at the same time, if you invest in a strong company, hopefully the stock price will go up. And as the stock price goes up, hopefully the dividends will go up too, because as a company makes more money and their profits grow, they'll be able to send out bigger checks to you. So if you invest in the right companies, you can win in a few different ways because you'll get bigger cash flow every single year. And the value of your stock, your investment, is also going up. Now, if you really want to understand what it would take to replace your income, in this case, assuming $40,000 a year with dividends, you got to understand what kind of dividends are out there. Now, I do got to give you a little bit of a disclaimer here because investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So you should always do your own due diligence and never blindly listen to a random guy on YouTube. And everything I'm talking about today are just examples. I'm not telling you what to invest in. I'm just showing you how the process works. So you want to always do your own due diligence, okay? Right now, at the time of me recording this video, McDonald's is paying a 2.3 annual dividend yield. Now, this can change with time, but this is what it is right now. If you wanted to invest money into McDonald's right now and make $40,000 a year in dividend income based off of this dividend rate, you would have to invest $1.7 million in order to get $40,000 a year in passive cash flow through dividends in McDonald's. Now, I know this is going to seem like a lot of money, but I'm going to show you how you can accelerate this. EIX, this is Edison International, the electricity company. They pay out right now at the time we're recording this video a 4.5% dividend yield. So if you wanted to get the same $40,000 a year in passive income through EIX, you would have to invest right around $888,000 into this company today based off of this 4.5% yield to generate $40,000 a year passively. If you wanted to do it through IBM, which is right now at the time we're recording this video, paying a 4.8% yield, it's going to cost you $833,000. And AT&T right now is paying a 6.9% yield. And if you wanted to get the $40,000 a year, it will cost you right around $580,000 today. Now, there's a couple things that I want to point out with this. One, this is not something that you have to just do today. If you want to build this cash flow, this dividend income, it's going to take time. And the way you want to do this is by every single month, every time you get paid, you want to put some money towards your investments. And the best way to do that is automatically. That way you don't accidentally forget to do it. But you want to consistently keep investing your money into these stocks or whatever dividend stocks you're looking at if your goal is cash flow, because now what you're doing is every month you're just building up this machine that's paying you. Maybe right now you're only making $5 a month, but over time that's going to grow to $50 a month. Then $500 a month. And so you got to understand that this dividend cash flow isn't something that just happens overnight. It's something that takes time. It's something you got to build up. So you got to get into the habit of understanding that every time you get paid, some of this money has got to go into your cash flow producing machine, your dividend stocks that are going to pay you with income. The second thing that I need you to understand is the risk. Because let's just say, for the sake of this example, that you look here at AT&T and you say, AT&T is paying the highest dividend, so I'm going to invest my money only into that company. And so now for the next 10 years, you keep investing some money into AT&T, but then AT&T goes bankrupt. If that happens, now all of this money that you put into it would disappear because this company just went down the drain. And now this wasn't your fault. It was the executives at AT&T that ran the company into the ground because you were just hoping to build this money printing machine. But the executives at AT&T didn't do a good job, so now you have to pay the price. So you got to understand that there is risk here. When you invest in individual stocks, you take on all the risk. So there are ways for you to mitigate that risk. Number one is by doing your research. If you want to invest in individual stocks, you have to keep up to date with the company. You have to read their earnings calls. You have to read their financial statements. You got to see how this company is doing. Because if you start looking at a company and you see the revenue starting to drop, you see the profit starting to drop, you see people not liking this company so much, then that's a red flag that you want to pay attention to. But if you don't want to really do all the work, then you shouldn't be investing in individual companies, individual stocks. Then what you want to be doing is investing in funds that give you exposure to dividend paying stocks, because there's something called ETFs, which stands for exchange traded funds, which give you exposure to a whole basket of stocks. So now instead of you trying to find the best companies to invest in, you can invest in an ETF, which gives you exposure to a whole bunch of dividend paying stocks. That way now, if one company goes bankrupt, you're okay. There's a whole bunch of other companies in there that are still paying you with cash flow, with dividends. So if one company goes down, you don't lose everything. So let's take a look at some ETFs. What you want to understand here is that not all ETFs are made equal. So when you're looking at ETFs, the way you do your research here is you can just research any ETF you want on Google, and it's going to pull up kind of like a fact sheet about the ETF, and it will tell you which stocks are in the ETF. So you want to kind of just get an idea of which companies are in there, because although you're not going to be doing the research on every single company and reading all the earnings statements, you want to kind of get an idea or a sense of what types of companies are in there. So if you're looking for cash flow and you invest your money into SDIV, which is a high dividend ETF, then this right now at the time of recording this video is a 7.25% annual yield, which means you would have to invest right around $530,000 today in order to get this $40,000 a year passively. If you invest your money into VYM, which is a Vanguard ETF for dividend stocks, this pays right now at the time of recording this video a 3% yield, which means you would have to invest right around $1.3 million today in order to get the $40,000 a year. The same concept applies here to ETFs as it does stocks. This is not something where you're just gonna write a one-time check today. If you really want to do this the right way, this is where you're going to want to have your money going into your investments every single month or every time you get paid. That way you can build this machine over time that is constantly paying you. And if you invest your money into a good machine, good stocks, good ETFs, then not only is your machine going to become more valuable, but your machine is going to be printing more money because the companies in your machine are making more profits, so they're paying out bigger dividends. A third very common way to invest your money for this passive cash flow dividends is by investing your money in REITs. A REIT is a real estate investment trust, and technically a REIT is a stock, but people look at stocks and REITs a little bit differently, just because stocks give you exposure to companies like McDonald's and AT&T and IBM. REITs give you exposure to real estate. So a real estate investment trust is a company that invests in real estate, and they kind of get their own kind of special classification within the stock market, because when you invest in a REIT, you are pretty much investing just for cash flow, because the way REITs work is they have a 90% rule, which says that REITs are required by law to pay out 90% of their profits to their shareholders, people like you, through dividends. And so REITs make money through rent, and they have to pay 90% of the profits out back to you through dividends. So REITs pay out a whole lot higher dividends, just because the whole point is to get this income through rent and then pay it out to you. The advantage for you to invest in REITs is that you don't have to deal with all the headache of trying to find the right properties, dealing with contractors, dealing with tenants, dealing with property managers. You're just investing your money into the company that manages and owns the real estate. A couple examples of REIT ETFs that give you exposure to a basket full of different REITs. Again, I'm not telling you what to invest in, just examples are SCHH, this is the Schwab REIT ETF, and then VNQ, this is the Vanguard REIT ETF. When I say Schwab and Vanguard, these are just different companies that create and manage these ETFs. If you're not sure what I'm talking about, I already made a video where I explain what Vanguard is and what Vanguard funds are. That video will explain all of that. So if you want to watch that, I'll link that video for you in the description below. But SCHH right now at the time of recording this video is paying 2.8% a year, which means you'd have to pay right around $1.4 million today in order to get this $40,000 a year. And with VNQ, you would have to invest right around $1 million today in order to get this $40,000 a year passively. If your goal is purely just cash flow, at this point you might be thinking, all right, well, if I'm just trying to make as much cash flow as possible, I should be looking for funds and stocks that pay off the highest yields. And you might be thinking, okay, stocks are a little bit risky because I don't know or don't want to do all that research, then I'll just put my money into an ETF that's paying the highest yield. The thing that you want to pay attention to is that you never want to make an investment decision solely based off of this yield right here, because this yield can be deceiving. This yield is based off of the current share price, the current stock price that a stock is trading at. And so if a stock is tanking, then artificially a dividend yield can look so much higher because the stock price is down and the dividend might not have changed yet. And so you might buy into a stock or ETF thinking that you're getting this amazing yield. But what could happen is this ETF or this stock is on the verge of failure, which is why your yield looks so high. So you never want to look and make your decision just based off of what the yield is. That's one factor that you can pay attention to. But you really want to look at the underlying fundamentals. What companies are in the ETF? How strong are these companies? What sectors are they in? Are these strong companies that will be around in the future? Same with stocks. You're going to have to do a lot more research and kind of upkeep here, because if you're investing in one stock or a couple of stocks for the long term, you want to make sure that these stocks are continuing to perform and continuing to grow. With an ETF, you really just want to kind of get an idea of the company that is managing this ETF. Like Vanguard is one of the most reputable companies out there when it comes to ETFs, because they were like the pioneers of index funds. And so you just kind of got to get an understanding of who is managing your money or what companies are you investing in, because you want to make sure that this company or this fund that you're investing in is going to be around for a long time and it's going to continue to pay you for a long time in the future. Now, when you're investing for cash flow, you got to understand the drawbacks, because when you're investing in one of these companies, these are big established companies. And the reason why they're paying out a dividend to you is because they have so much money in their account that they don't know what to do with it. So the best use of this money is just to pay it out to you, the shareholder. You can compare that to a startup company, where this company, a startup company, might be using all of their money and more to grow as big as possible, as fast as possible. Like you might have heard that Uber was losing money for so many years. They were not profitable. Why? Because they were spending every penny that they had to grow quickly. And so not only were they spending all of their money, they were also losing money because they kept raising more money, getting into more debt. That way they can use this money to grow bigger. That way their company would become more valuable. So a company like Uber could see the stock price grow very quickly. I mean, they could see a 20%, a 50%, a 100% growth in revenue, and it really wouldn't be too surprising because they're a startup company and they're trying to grow very quickly. And so they're trying to see their stock price explode. You can compare that to something like McDonald's, where you're not going to see 100% growth in the revenue like that, because this company is not in that same ballpark. McDonald's is very big. They're very established. They're just trying to slowly keep growing their stores and keep growing their income slowly. That way they can just kind of maintain their dividends and maintain their growth. So this is where you kind of really got to understand what your goals are, because dividend companies are not going to give you that massive growth versus a startup company could. But at the flip side, a startup company also has more risk. A startup company could fail. It could go bankrupt. I mean, there's a lot of risks with investing in a startup company. With these companies, you have less risk. I mean, they can still fail. There's less risk, but you're not going to see the massive boom in the stock price that you could see with a startup company. I mean, over the long term, yes, you want to see the stock price go up, but your goal here is just that consistent cash flow. So you want to keep that in mind. The second thing that you want to make sure you understand are taxes, because now when you make this dividend income, it's taxable. The IRS is always going to want to get their cut when you make money. The way I want you to think of it is like a machine printing money. And the way that you can get more machines printing money is by using more money to buy more machines. So you have this one machine that's printing you money. And anytime it prints you money, you take this money and use it to buy another money printing machine. Now you have this machine printing you money, and when it makes you money, you use this money to buy another money printing machine. And now this money printing machine is also making you money. So now the first money printing machine is making you money, the second money printing machine is making you money, and you take all this cash and you use it to buy a third money printing machine, and on and on and on. This is what compounding is. And this is what they call DRIP, D-R-I-P, in a lot of stock brokerages, where you're now reinvesting your dividends automatically. The thing that you have to understand here is, yeah, you can take all of your dividends and reinvest it, which is good. It's a way for you to grow and accelerate your cash flow, because now not only are you putting more money into your investments every single month, but you're also using your profits from your investments every time you get paid to buy more shares. That way you're really just kind of building a big machine that's going to keep producing you more money year after year after year. But the thing that you have to remember here is, even if you don't take any of these dividends out and put them into your bank account or use them, you're still going to have to pay taxes on these dividends. So even if you reinvest all of your dividends, you're still going to have to pay taxes on the dividends that you received, even if you never use the dividends in your own personal account. Now, this is assuming that you're investing in dividends in your own personal account. If you're investing in dividend stocks through an 401k or an IRA or one of those tax deferred accounts, then you don't necessarily have to pay taxes on those dividends depending on what your account is. But If you're investing in your own personal account, then you're going to have to pay taxes on your dividends, even if you reinvest all of your dividends. Now, that's not a bad thing. I don't want you to stop investing your money or reinvesting your money because you're going to have to pay taxes on your profits. It's just something I want you to be aware of. So if your goal is to build up this machine that's paying you with cash flow, that way you can live off your dividend income, what you got to do is first figure out what you want to invest in, stocks or ETFs, or which kind of basket of stocks and ETFs. Second, anytime you get paid now, you're going to take a portion of your paycheck and automatically invest it into the stock or ETF that you want. Third, now when you get paid through your dividends, you want to reinvest these dividends back into your stock or ETFs. That way your dividends are building you more machines that are producing you more cash flow. Now, not only are you investing more money every single month, but your money that you're making is also going back into your machines to buy you more stocks and more ETFs. And fourth, you just got to remember that you're going to have to pay taxes on the dividends that you made, even if you don't get to put them in your own personal bank account today. If you do this, you're going to be building up a machine that's going to be building up your cash flow. And yeah, it's going to start small, but over time, you're going to start to see this dividend machine grow faster and faster and faster because you'll have more money going into your dividend accounts, and your dividend accounts are going to keep producing more money, which is going to go back into them, buying you more shares that are paying you with dividends. We're going to jump back into the show in just a minute, but first, here's an advertisement from our sponsor, me, with Briefs Media. If you're looking for an easy way to stay up to date on what's happening in the top finance and business news, we make it super easy for you to do that at Briefs Media because we created a free newsletter called Market Briefs. Market Briefs is a super simple and easy way for you to stay up to date on the top finance and business news. You can read Market Briefs in less than 5 minutes every morning. It's a fun and witty and easy to read newsletter, and I promise, if you join Market Briefs, you are going to love it. Now you might say, Jaspreet, how can you promise that I'm going to love Market Briefs? Well, if you don't love Market Briefs, you can unsubscribe at any time because it's completely free. So if you have not joined Market Briefs yet and you want to stay up to date on what's happening in the top finance and business news, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And with that, let's go back to the show. Let's talk about investing for cash flow, because unfortunately there's a lot of, let's call it poo-poo information out there on the internet when it comes to the topic of cash flow investing, because a lot of people say, oh, if you want to get rich, just get this passive income, create this drop shipping site, start this Amazon store, create this ebook, and you're going to be making passive income, this cash flow. But the reality is, number one, that's not passive. And number two, it is so difficult to generate this type of cash flow. The way that real cash flow investing works for investors and help people become extremely wealthy with cash flow is like this. I'm going to draw you right here. For my male followers, I'm going to draw you a mustache, and for our female followers, I'm going to draw you a braid. In my native language Punjabi, we call a mustache a much and a braid a gut. So now you go to work every single day at this job. Maybe this job is your business, and then this job is going to pay you a salary. Now you're going to take a piece of the income that you did not spend at Gucci and Chipotle, and you're going to take this money and you're going to invest it into this asset. Now this asset could be something like a dividend paying stock. It could be something like real estate. I'll talk about how you can do this in just a minute, but now you're going to take this money, put it into this asset that's going to be generally passive on your end. Not completely passive, but generally passive. And now that you own this asset, it is going to pay you with cash flow. Maybe you get a check every month. Maybe you get a check every 3 months. Maybe you get a check once a year. Just depends what this asset is. And now you can take this money that you're generating and you can either buy more of these assets that are going to pay you with more cash flow, or you can take this money and use it to go out and buy you a brand new car. That's going to be your choice, but this is how real cash flow investing works. Now, the thing that you need to understand about cash flow investing that nobody wants to talk about on the internet is that you don't get rich by investing for cash flow. You got to be rich first to get a lot of the cash flow that will make you wealthy. The reason why is because you got to take the money that you're earning that you don't spend at Chipotle and Gucci, and then you take this money to buy these assets. So you need the money to generate the cash flow in the first place. And this is why it's so difficult, is because people hear this idea of generating passive income and cash flow, and it sounds very exciting. But the reality is, when you generate this cash flow, you're generating a return on the money that you invest. So let's assume, I'm going to be very generous here. Let's assume that you can get a 10% cash flow return. That's very high, by the way. But let's assume you can get a 10% cash flow return. That means if you invested $1,000 into this asset, you're going to generate $100 after 1 year of cash flow. $100 from $1,000 is not going to really pay you much. I mean, it's not going to fund really anything in your life. Even if you invested $100,000, then you're only generating $10,000 a year. Now, $10,000 a year is a lot, but it's not even $1,000 a month. It's not life-changing money for you to go out and start driving a Rolls Royce. You need the money to invest to generate the cash flow. This is where people say, but Jaspreet, if I need millions of dollars to generate a lot of cash flow, what's the point of me even doing that? Well, the point isn't for you to go and invest into this cash flow asset today and never do it again. The point is you go to work every single day. You get this paycheck every week, every 2 weeks, every month. Every time you get paid, you're going to take a little bit of this money and buy this asset. Now, when you do this week after week after week, month after month after month, year after year after year, decade after decade, now you're going to be building a solid stream of cash flow, especially if you're taking this cash flow that you're generating and using it to buy more assets, because now you're making money to buy cash flow, and the money that your money makes is buying you more cash flow as well. And now if you do this for long enough, now you're going to be able to build a solid stream. Now, the more money you invest into this asset, the more cash flow you're going to be able to generate. And this is why I call it the decade of sacrifice. Because if you put in a decade of time where you're working to live smaller so you have more money here, and then you take this money and you use it to buy these assets that are paying you with cash flow, well, now after a decade of sacrifice, you are going to be able to reap the rewards of that, which is now you're going to finally have a solid stream of cash flow. So if you want to go through this decade of sacrifice, which is not easy, I mean, it's the reason why the majority of people will never become financially successful or wealthy. The majority of people do not want to make this financial sacrifice of you working to live smaller and earn more money, not so you can drive a BMW, not so you can buy all the fancy Gucci, not so you can have a big home, but so you can have more assets. And if you put in that work to own more assets that are paying you with cash flow, now you got the checks coming in every month, every quarter, every year, and now you have this money coming in without you physically working, because remember, you got to work here to get this check. You don't got to work here to get this check. This asset cash flow is coming in passively. The only thing you got to do here is make sure that your assets are still good, making sure that you still own a good portfolio of stocks, making sure that your real estate is still good. All you got to do here is monitor it. Here, you got to go into the office or go into work and keep getting that paycheck, because if you don't work, you don't get that paycheck. Here, if you don't work, you still get paid. But in order to get paid here, you got to keep contributing money here week after week, month after month, year after year for at least a solid decade. And if you do that, now you're going to have a brand new stream of income that can allow you to drive that nice car without worrying about the price. You have the money coming in here that will allow you to go on those vacations and not have to worry about the price. You got the money coming in here to buy the fancy clothes, and you don't got to worry about paying for it, because it's your assets that are paying for it. It's not what you are working to pay for. This is how wealthy people really become wealthy, because if you can build this type of cash flow, well, now you have true financial freedom, because now you have assets that are paying for your lifestyle instead of just you working to pay for your lifestyle. This is what it means to become wealthy, because now it's your assets that will fund your finances. So what are these types of assets that you can invest in? That way you can generate this type of cash flow. Now, I'm going to go over mainly two types of assets. I'm going to talk about stocks, and I'm going to talk about real estate, because these are probably the two most accessible ways for the average person to generate this type of cash flow. When you go out and you invest in a company in the stock market, what you're doing is you're literally buying a business. If you go out and you buy one share of the Amazon company, you become one of the owners of the Amazon company. If you go out and you buy one share of the Apple company, you become one of the owners of Apple. If you go out and you buy one share of Chipotle, you become one of the owners of Chipotle. If you go out and you buy one share of Sweetgreen, you become one of the owners of Sweetgreen. You get the idea. Now you're literally buying one of the pieces of ownership in that business instead of just buying a product that this business sells. Most people just think about businesses as their products. You go and buy things on Amazon. You buy the newest iPhone. You buy a Chipotle bowl. You buy a Sweetgreen salad. That's how most people are wired to think. When you go out and you invest in a stock, now you're actually buying the business instead of the product. Well, some companies in the stock market, not all of them, but some companies on the stock market pay what's called a dividend. A dividend is a cash payment that you get as an investor for doing nothing except owning the stock. Now again, not every company pays out a dividend. And the reason why is because for a company to pay out this dividend, they have to have a big profit. So now when a company makes a profit at the end of the year, there's three things that they can do with this cash. Number one is they can save this money in case of an emergency. Number two is they can reinvest this money back into the company. Or number three is they can just give it away to you, one of the shareholders, one of the owners. Now, when it comes to saving the money in a company, you got to think from the perspective of a business owner. If a company makes $100 million of profit and they kept $100 million in their bank account, well, that's dead cash sitting there. Not every company wants a ton of dead cash sitting there because the $100 million isn't generating a return for the company. Companies want to do something with their money, or at least give this money to their owners. And so if a company has a big enough bank account or a big enough savings account, they might not want to save more money, which then brings us to option two, which is reinvest the money back into the company. Now, if it's a smaller startup growth company, you bet they're going to want to invest all of this money, maybe and some more, through debt and other investment money back into the company because they want to grow bigger. They want to expand their market share. They want to be a larger company. And when a company is trying to grow, they're going to be investing everything that they can to open new stores, open new manufacturing plants, open new research and development facilities. That way they can keep expanding and growing their market share. But when a company becomes even bigger, and now you're a much larger conglomerate, and you don't really see that opportunity to keep investing and growing as quickly, now you might not want to reinvest all this money back into the company, which leaves now this cash back in the bank account. And if you don't want to just save it, well, then you can give this money away to the shareholders, people like you who own a piece of the stock. Now, this is called a dividend. And companies that pay a dividend generally pay out this dividend quarterly, meaning every 3 months. So now, if you buy a stock that's paying a dividend, that means you're going to get a cash payment every 3 months for doing nothing except owning the stock. Now, does this come with risk? Of course. If you invest in a company on its way to bankruptcy, well, eventually they might cut that dividend, or they'll have to cut that dividend. Plus, you could also see the value of that stock fall. And this is where you have to understand how to value an investment and know how to research a good stock. And you might be saying, but Jaspreet, I don't want to do all that. I don't want to keep up with the company. I don't want to research the stock. I don't know how to do that. I don't want to research the financials. That's okay. You don't have to. The alternative to investing into an individual company is to invest in something like a fund, maybe a dividend-paying ETF, a dividend-paying index fund, a dividend-paying mutual fund. Now, instead of investing in one company like, let's just say, Apple, now you can invest into a basket of companies that have, say, 500 different companies in here, and Apple is just one of the companies, and there's 499 other dividend-paying companies in here. So now you can go out and find these dividend-paying funds. Again, you have ETFs, mutual funds, index funds. You go out and find one of these dividend-paying funds that invest in companies that are paying a dividend. Now you invest in one thing that's investing in 500 different companies. Now you can lower your risk because if Apple were to go bankrupt, well, now you have 499 companies to balance it out. This way you can lower your risk and keep getting those dividends. That way now you can just keep throwing your money into one of these funds. So this is option one. You can invest into an individual company. I am not telling you what to invest in, just giving you an example. You can invest into an individual company that's paying a dividend, or you can invest into a fund that's paying a dividend. But again, the key is you got to just keep reinvesting that money. Option number two is you invest in real estate. Now you're going to go out and buy a property. Maybe it's a house, maybe it's an apartment complex, maybe it's an office building if that's something you're into, maybe it's a retail building, maybe it's a mixed-use building, maybe it's a storage building. You're going out and you're buying this property, but you're not buying it to live in or use yourself. You're buying it to rent out to somebody else. So now you buy this property, you rent it out to somebody else, maybe they'll live in or use this property, and then in exchange for them living in and using your property, they pay you rent. Now the key here is this rent has to be enough to cover your property taxes, your insurance, your maintenance, your management fees, any vacancy costs, and then if you have any debt, cover that as well, and then put some money in your pocket each and every month. That's the right way to invest in real estate. You have some people, especially when you're in a very hot seller's market like we've been seeing, when you're in a very hot seller's market, you will see investors go out who have a lot of cash, just go out and buy properties and say, you know what? I'm okay losing money every single month because I think this property is going to be more valuable next year. So I'll be able to flip it for a profit. That's not the game that I play. That's too risky, that's too speculative because I have no idea where housing prices or real estate prices are going to be in a year. I don't like to play that game. What I like to do is I want to make sure I can make a profit in my cash flow every single month and just keep working to accumulate the cash flow. I just want to keep stacking the cash flow because now I know, okay, this property is going to make me $250 a month. If this property is going to make me $250 a month, I got to buy a second one for another $250 a month. After 10, I got $2,500 a month coming in profit. After 100, I got $25,000 coming in profit. And now it's a game of just stacking cash flow and how fast can I stack that cash flow. Now again, you don't have to be a real estate investor. You don't have to invest in stocks, but you have to start putting your money to work if you want to start generating the cash flow. There's some people on the internet that say that the only way to build wealth is to invest in real estate. Well, there's a lot of people that have become extremely wealthy without ever touching real estate. You have some people that say you have to go out and invest in the stock market if you want to be wealthy. Well, there are some investors that only invest in real estate that have never touched the stock market that have become extremely wealthy. What you need to do is find the right balance for you. Personally, I invest in stocks and I invest in real estate. It's just something that I'm interested in. You don't have to go out and blindly follow anybody else. You don't want to be a sheep. The idea is for you to go out and build your financial education, learn how to invest, and find the right strategy that works for you, that works for your family, and that works for your financial goals. Because at the end of the day, if you want to invest your money, you just want to make sure you get the best returns. For me, I like cash flow because cash flow is something that I can predict. And when I got the cash flow coming in, well, now I know I can go out and spend my money, at least the cash flow that I'm generating, and not really have to worry about it because even next month, I'm going to get another cash flow check. That's the way that I like to run my finances. So if you want to invest your money, you got to figure out the right strategy for you. And well, this goes over a couple ways that you can invest your money for cash flow. We're going to jump back into the video in just a second. But before we do, here are a few words from our sponsor, Fundrise. But before I give you this advertisement, I do have to give you a disclaimer, which is that I do have some of my own personal money invested in Fundrise, and I also own some equity in the Fundrise company as well. If you've been thinking about investing in real estate, but you don't want to deal with the headache of property ownership, Fundrise makes it easy for anybody to get exposure to real estate investments with as little as $10. And now you don't have to worry about going out and buying a property yourself. You don't have to worry about managing tenants, and you don't have to worry about unclogging toilets. The way it works is you invest your money into Fundrise and you're getting exposure to a portfolio of real estate properties. And then you will get paid your share of appreciation and cash flow if your fund makes money. Remember, this is investing at the end of the day. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The nice thing about Fundrise, though, is now you can passively invest your money into real estate without having to deal with all the headache of property ownership. Second, Fundrise has an auto invest feature. That way, if you want to continually invest more money into real estate, you can do that through Fundrise. And third, they have a very cool dashboard that you can use to track the progress of your investments. Now, the last thing that I want to remind you is that when you invest your money in Fundrise or real estate in general, your money is not as liquid as it is when you invest your money into the stock market. So you have to remember, if you're going to invest your money in real estate, whether it's to buy an individual property or to invest your money into a fund through Fundrise, you are investing your money for the long term because you're investing your money in real estate. So if you want to learn more and see how you can start investing with Fundrise, I got the link to how you can do that down in the description below. Minority Mindset is a paid partner with Fundrise, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and see how you can start investing in real estate through Fundrise, I got the link to how you can do that down in the description below, where you can go to theminoritymindset.com/Fundrise. That's theminoritymindset.com/Fundrise. And with that, we'll go back to the show. Everybody says that if you want to become rich and wealthy, all you have to do is throw your money in the stock market. But if it was so easy, why are so many people losing money in the stock market? That's why in this video, I'm going to give you a comprehensive guide on investing your money in the stock market. And if you watch this video until the end, you are going to know more about investing in the stock market than the vast majority of people. The stock market is one of the most accessible wealth building tools that we have, but the issue is most of us are never taught about how to use the stock market the right way. For a lot of people, stock market investing is finding a hot stock, throwing your money into it, and then watching your money disappear. Oh, not again. If you really want to understand the stock market, there's 5 things you need to know. First, you need to understand what is the stock market. In this section, I'm going to be going over what's the Dow Jones, NASDAQ, S&P 500, why does the stock market exist, and how do stocks work. After that, we're going to be talking about how you can make money. So this is the difference between making money through dividends and appreciation, what causes a stock to go up, Then we're going to talk about different investing strategies. You might have heard people talk about fundamental analysis, technical analysis. I'll be talking about active investing and passive investing in this section. Then I'm going to be talking about some of the different investment options you have. You might have heard people talk about things like growth stocks, blue chip stocks, REITs. We're also going to be talking about mutual funds, index funds, and ETFs. And then we're going to wrap it up by talking about how do you actually research the stocks and take action. So this is looking at things like 10Ks, 10Qs, researching stock charts. This is where you actually are making the money because now you're taking action. I'm going to be going over these 5 things in this video, but before I do that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. Let's start with this. What in the world is the stock market? The stock market is a place where you and I, regular people, can go and invest in companies. When you invest in a company, you become one of the owners of a company. So if you go out and you buy one of the shares of the McDonald's stock, you become one of the owners of McDonald's. Now, if you just buy one stock, you're not a major shareholder. I mean, you only own 1/750 millionth of the company, but you're still one of the owners of McDonald's. And as an owner, you actually get the right to vote on some of McDonald's business decisions. A company that trades on the stock market is known as a public company because this company is publicly traded, meaning anybody can go and buy shares of this company on the stock market. You can compare that to a private company, kind of like ours, Minority Mindset, because you can't buy shares of Minority Mindset on the stock market. If you wanted to buy an ownership stake in Minority Mindset, you would have to call me up and I would say, sorry, we're not selling. The reason the stock market exists is it's a way for companies to finance the future growth. So if you are a big company and you need more cash to grow, then what you could do is you could sell 20% of your company now instead of to private investors to the public market on the stock market by now giving this 20% of ownership to the public on the stock market. Now you are a publicly traded company and everybody knows how much your company is worth, and people have the opportunity to buy shares in your company. When you hear people say things like the stock market is up or the stock market is down, what they usually mean is an index like the Dow Jones or the S&P 500 or the NASDAQ is up or down. So these are called indexes because they're essentially baskets or groups of stocks. The Dow Jones is a group of 30 very big companies. The S&P 500 is a group of 500 of the largest companies on the stock market, and the NASDAQ is a group of tech companies. So they're called indexes because they're groups of stocks, and they essentially just give you a sample of what's going on in the broader stock market. When you invest in the stock market, you can invest into individual companies like McDonald's, I mentioned that just a minute ago, or you can invest in an index and get exposure to the broader stock market, but I'll be talking about that in just a little bit. Second, how do you make money in the stock market? Well, in general, the goal in the stock market is to invest in a company that becomes more profitable and makes more money. That way you make money, but the way you make money is one of 2 ways. When you invest in the stock market, you can make money through appreciation or dividends. Appreciation is when you invest in a company and the value of a company goes up. So if you invest in a stock and you buy the stock at $100 a share, and 2 years later the stock goes to $200 a share and you sell it, the $100 of profit that you just made is called appreciation. Other times you can also make money through dividends. Dividends are literally just cash payments that a company gives you because you invested in a company. So if you go out and invest in a company that's trading for $100 a share, sometimes this company is going to send you a $5 check every single year just because you own shares of this company. You can think of it this way. When a company is mature and they have a lot of cash and a lot of profits, there's 3 things that they can do with their extra cash. They can save this cash for an emergency, they can invest this money back into their business, that way they can grow bigger, or they can reward you, the shareholders, the investors, by giving you some cash. That way now you're happy for investing in this company, and this will attract more investors to want to invest in this company. Most dividends are paid quarterly, meaning every 3 months. So if you invest in a company that pays a dividend, you're going to get a check every 3 months, or if you want, you can have this cash reinvested into your stock. That way now instead of getting a physical check, you are getting more stock in the company. Now, dividends sound cool. I'm a big fan of dividends, but there are a couple drawbacks with dividends that I want you to understand. First, when a company pays a dividend, you have to understand that means the company is not necessarily going to grow as fast, because if a company is paying out $1 billion in dividends, then that's $1 billion the company is not using to actually grow the company to make more profits and make more revenue. So if you have a company that's paying out a lot of dividends, you're typically not going to see as much appreciation as you would if a company was using this money that's spent on dividends to actually grow the company. So if a company is paying out dividends, they're usually more stable companies and they're bigger companies because they have a lot of cash that they don't really want to invest back into the company, so they're rewarding their owners with the dividends. Second, with dividends, you have to pay taxes on your profits. So this is kind of like your pro and con. You have to pay taxes on all of your income, but with dividends, if you are reinvesting your dividends back into the company, you're not getting this cash in your hand, but you still have to pay taxes on the profits that you got. Not every company pays a dividend. So if this is something you're interested in, you have to look into the actual company and see if they're paying a dividend or not. And like I was saying before, the companies that pay dividends are typically your larger, kind of more mature and established companies, because your smaller companies, your growth companies, the tech companies, the ones that are really trying to grow fast, they're investing every dollar they can back into the company because their goal is to grow as big as possible, as fast as possible. So companies like that, their goal is to grow their stock price as fast as they can. The advantage with that, if you're investing in a company that's investing heavily in their growth, is you don't have to pay taxes on dividends because you're not getting any dividends. A company is investing their money back into the company, so hopefully you have a big stock price and you don't have to pay any taxes on your appreciation until you actually sell your stock. So that's one of the advantages of appreciation. But one of the downfalls is it also comes with more risk because there's a chance that the company will fail, and if the company fails, you don't have anything to show for it because you didn't get any cash through dividends. So they both have the pros and cons, and as an investor, you need to know why you're investing. Are you investing for this or this? The question now you might be wondering is, what causes a stock price to go up? Well, on a very broad level and a very simple level, stock prices go up based on supply and demand. If you have a lot of demand to buy a stock and there's not a huge supply of stock, then the price of the stock is going to go up because you're going to have buyers that are fighting each other to buy the stock, and this is going to push the stock price up. And if you have a lot of supply but no demand because nobody wants to buy the stock, then you're going to see the price of the stock fall. In the short term, the supply and demand is really fueled by emotion. Like, people might think, oh my God, Tesla is the future, and everybody gets behind Tesla, and then you see this huge demand to buy Tesla, so the price of Tesla stock goes up. But in the long run, what really affects the stock's price is its fundamentals. That's how much money is the company making, how are their profits looking, are their revenues growing, are their profits growing, how is the management, and are they innovating for the future? So these are the things that really affect a company's stock price over the long term. But in the short term, a company's stock price can be really volatile based off of people's emotions because the stock market is emotional. If you want to invest in stocks, it is very simple. All you have to do is open up a free account with a stock brokerage, and then you can buy or sell whatever stocks you want. Back in the day, it wasn't so easy. Back in the day, if you wanted to invest in the stock market, you'd have to call up a stockbroker, and then the stockbroker would then have to make a deal with Wall Street and then buy or sell whatever stock you want. It was a very long and difficult process, but now it is very simple. Third, let's talk about investing strategies, because there's more than one way to invest in the stock market, and this is one of the biggest mistakes that people make when they invest in the stock market, because for a lot of people, their strategy is invest in a company that I think is going to be big, and then when it goes down, sell it for a loss. There's a lot of ways to invest in the stock market, and you need to have a strategy on how you're going to make money. If you want to be a stock market investor, then when you buy an investment, your goal should be to own your investment for at least a year. Because if you don't own your investment for at least a year, then you're also going to be subject to higher taxes, because the way that the tax code works, if you own your investment for longer than a year, then that's categorized as long-term capital gains and you get lower tax rates. But if you buy a stock and sell it for a profit in less than a year, then you're going to be subject to higher taxes called your ordinary income taxes, because the United States government and the IRS doesn't look at that as an investment, because now you're just trading, you're flipping stocks. This isn't to say that you cannot make money trading stocks. This is for you to understand what your goal is as an investor, because if you don't know what your goal is as an investor, you're not going to be able to come up with a strategy. On the very highest level, there are two different kinds of investment strategies. There is an active way of investing in the stock market and a passive way. An active investment strategy means that you're now actively researching companies and stocks and you're buying based off of that. And passive means you're not really doing much research. You just have some money automatically being invested for you every week or every month. Now, within this type of active investing, there's a whole bunch of different strategies that you can use, but they ultimately come down to doing two different types of research. You can either do fundamental research, so I'm gonna call it fund, or technical research. Or you can also do both depending on what strategy you have. But those are the two types of research you can do, fundamental or technical. As a passive investor, you're mainly going to be looking at the fundamental type of research. Fundamental research means you're looking at the company itself. You're looking at how much money a company is making, what their profits are, who the management is, and how they're innovating. Technical research means you're looking at stock charts. You're looking at momentum. You're saying, oh, this company looks like it's about to go up because of all these indicators, and so you buy based off of that. Warren Buffett is a fundamental investor. He likes to look at companies, he likes to read financial statements, and he wants to find a company that's undervalued, and he wants to own it for a long time. That way he can make a profit over the long term. And he is an active investor because he does the research to actually find the companies to invest in, and he is the one that's picking these stocks and doing this research, and he makes these decisions when he thinks it's a good time to invest. You can compare that to a passive fundamental investment where now you can pick a few stocks or a few funds that you want to own, and then every single month you have $100 or $1,000 or $10,000, whatever you can afford. You have this money going into your investments, being divided up into your 3 or 5 funds, whatever you have, and this is just passively happening without you actively trying to find new funds. It's just every month or every week, more money is just being invested into your account. Technical trading is now when you're looking at stock charts and you're looking at momentum. You're looking at different indicators that tell you that you think the stock price is going to go up. Maybe you're looking at how many people are buying the stocks of the volume. Maybe you're looking at moving averages to kind of see the trend of which way the stock price is moving. So you're looking at different indicators to tell you that you think the stock market is going up, at least in the short term. If you don't like the idea of putting time into the stock market, or if you don't care about studying companies, or if you don't care about stock charts, then passive investing is probably best for you because this one requires the least amount of work. You find a few stocks or funds that you want to invest in, and then every week or every month, you are just going to continue to put money into that. If you like the idea of looking at companies, but you don't like the idea of looking at stock charts or looking at these moving averages, you just want to invest in a company like Warren Buffett does because you want to find an undervalued company and invest in it for the long term, then being an active fundamental investor is probably best for you. If you don't like the idea of waiting years to potentially see a profit, then technical investing is probably better for you. Now, while technical investing can make you the most money in the short term, it also comes with the most risk because your goal is to make money in a shorter amount of time. A lot of technical investors are buying and selling stocks within a year. Fundamental investors are usually looking to make money over the long term. So now we're talking multiple years, and so there's less risk, but also less opportunity to make a whole bunch of money very quickly. For the vast majority of people who don't care about studying companies or reading financial statements or spending time learning the stock market, passive investing is the right way to go. Now, I already made a video where I went over passive investing in good detail. So if you want to watch that video, I will link it for you in the description below. Fourth, let's talk about the different types of investments on the stock market, because one way you can invest in the stock market is by investing in stocks. But that's not the only way that you can invest in the stock market. You can invest in the stock market and make money in the stock market by investing in individual stocks. You can invest in mutual funds, you can invest in index funds, and you can invest in ETFs. If you are subscribed to our YouTube channel, you've probably heard me talk about these things before, and if you're not subscribed to our YouTube channel, you should probably do that. Stocks are when you're investing in individual companies. This is what I've been talking about most of this video. So if you invest in the McDonald's company, or in Lululemon, or in Tesla, or in Amazon, or in Apple, now you're investing in individual companies. And within the stock segment, there are different types of stocks out there. Like, you can invest in blue chip companies. These are your more stable, more established, your larger companies. You can invest in growth companies. Growth companies are your startups, your smaller companies. These are companies that are investing heavily into their growth. So growth companies are not companies that are paying out dividends. These are companies that are spending every dollar they have back into their company to grow as big as possible, as fast as possible. So more risk, but the opportunity to see more appreciation. You have things like REIT stocks. REIT stocks stand for Real Estate Investment Trusts. These are companies that pay out high dividends because these companies make money through rent, and the law says that REIT stocks are required to pay you 90% of their taxable income through dividends. So REITs give people exposure to real estate, and you can make income through dividends without having to go out and physically buy real estate. So these are a few ways that you can invest in stocks. And again, you want to invest in stocks based off of your investment strategy, your investment goals. But this isn't the only way to invest in the stock market, because the downfall with investing in stocks is if you invest your money in a stock, let's say Amazon, and Amazon starts to fail, they start losing money and they go out of business, then all of your money goes down the drain. Now you might be thinking, oh, Amazon's never gonna fail. But you know, companies do fail. And if you invest in a company that fails, then all of your money is gone. That's where these options come in handy. Mutual funds are indexes, so a group of stocks that are managed by a very experienced and usually a very expensive money manager. So when you invest in a mutual fund, you are paying this money manager to find you a portfolio and investment of stocks, and this person is going to manage your stock portfolio, and their goal is to help you beat the market, and in exchange, you're going to pay them a fee. Index funds work very similar to mutual funds, except with index funds, you're not paying a money manager to manage your account. This is passively managed by a computer. So essentially with an index fund, you can invest into an index, like you can invest into an index that gives you exposure to the top 500 companies on the stock market. And now if these top 500 companies go up, your index fund goes up. If these top 500 companies go down, your index goes down. The advantage with index funds is you tend to have low fees, you tend to have less risk, and you can typically match the returns of the stock market. The downfall is you typically have less potential upside because you might have some great companies in your fund, but they're going to be balanced out by the losers. But this can be a good way for you to invest and get low fees and get exposure to the general stock market. An ETF is an exchange traded fund, and this is kind of like a basket statement because all this means is this is a fund that you can buy and sell on a digital stock brokerage. So the reason the word ETF even exists is because a lot of mutual funds cannot be bought and sold on the stock market. If you want to buy a lot of mutual funds, you have to call up a broker and purchase shares of a mutual fund manually. With an ETF, it's all electronic, so you can buy and sell shares of this ETF kind of like you would any other stock. Now look, I am just a random guy on YouTube, okay? So you should always do your own due diligence and never blindly listen to a random guy on YouTube because investing has risks and you are never guaranteed to make money when you invest. But a couple examples of index funds that give you exposure to the general stock market are VOO and SPY. If you invest in one of these two funds, you will get exposure to the top 500 companies in the stock market, and now you don't have to go out and try to find the best stock to invest in. Now you're investing in the general stock market. I want to kind of give you an idea of what long-term returns in the stock market look like when you play the stock market for the long game. So over the long term, the stock market typically goes up by somewhere between 7 and 10% a year. Now, this doesn't mean the stock market always goes up, and this doesn't mean that it always goes up by 7 to 10% a year. This means on average, it goes up by 7 to 10% a year. Some years it'll be more, some years it'll be less. Sticking with the lower end of the equation, let's say you invest $10 a day or $300 a month, and you can get a 7% return on your money, and let's say you do this for 45 years. So you start doing this when you are 21 years old, and you continue to do this until you retire at 66. If you do this, and every single month you invest $300, you will retire with $1.1 million from your $10 a day investment. The reason I want to show you this because let's say you start a little bit later. Let's say you start investing not at 21 but now at 31, and you continue to do this until you're 66. So now this is 35 years, but you're still doing the same investment. You're still doing $10 a day or $300 a month. Now, if you do the same investment, you're not going to retire with $1.1 million. You're going to retire with $535,000. Still a lot of money, but you're leaving a lot of money on the table because your money doesn't have as much time to compound. Time is very important when it comes to investing your money over the long term because every single year your money has more time to grow and compound, and the longer you let your money grow, the more wealth it's going to build you. If you want to grow your money even more, then there's two things you can do. You can either invest more money or invest your money more aggressively, meaning get a better rate of return. So let's assume now that you're investing $20 a day and you continue to get the 7% return a year. If you do this for 45 years, so you start when you're 21 and you continue to do this until you're 66, then you are going to retire with over $2.2 million from your $600 a month investment. If you cut 10 years out of the equation because you didn't know about investing until you're 31, so you do this for 35 years, now you will only retire with $1 million. Now, I know, only $1 million. $1 million is still a lot of money, but you're leaving a lot of money on the table by not starting sooner. This is where a lot of people say things like, oh, I didn't start investing when I was younger. Did I miss my shot at becoming wealthy? Is it too late for me to start investing? No, it's not. Remember what I said before. If you want to get better returns, you either have to invest more money or invest more aggressively. Maybe you have to invest more money, or maybe you have to be a little bit more active with your investments. That way you can get a better return. So now let's go through this example again, where you're investing $20 a day and now you're a little bit more aggressive. So you're trying to get a 10% return. If you do this for 45 years, just to show you the example, now you're going to end up with $5.5 million. If you start a little bit later at 31 years old and you do this for 35 years, now you're going to end up with $2.2 million, so you're still a millionaire. And if you start this at 41 years old, now you only do this for 25 years, you're still going to end up with $750,000 in retirement. So time and consistency are very important for you to build this wealth over the long term. And if you're trying to make up for this lost time, then you need to either invest more aggressively or invest more money. And if you don't have extra money to invest, then you might have to look into doing something like a side hustle or starting your own business. That way you have extra cash to invest. That way you can build your wealth. And this is also more of a passive investing structure. Right now, you're not trying to get amazing returns. You're just trying to match the market by passively investing your money into a fund that gives you the same returns as the stock market. Active returns can get you better returns, but again, it comes with more risk. Like if you had invested $10,000 in Amazon back in 2010, that $10,000 investment would have grown to $170,000 in 2020, but that again comes with more risk because there's a lot of companies that didn't get the same returns as Amazon. Now, when it comes to research and taking action on your investments, you have to understand that the investors that make the most money are not the investors that invest on emotion. It's the investors that invest on financials. A lot of people are investing in the stock market when they feel excited because they think, oh my God, so many people are making money in this stock, so let me buy in. And then when the stock starts to come down, they panic and they sell. If I had to diagram it out for you, it looks something like this. So you see a stock go up like this, then somebody at this point gets excited, they get greedy and they say, oh, everybody's making so much money because the stock has shot up so much. So now they come in and buy at the peak. And then people realize that, oh, this stock might be a little overvalued. So they start taking off their profits right here. And what do you see happen? The stock price starts to come down. And now when the stock starts to come down, people start to panic sell. And now this is where you sell because you panic, you get worried, you see your stock in the red, and so people sell. I do not want you to be an emotional investor. I want you to be a financial investor, which means you need to know how to do the research. That way you can find the information you need to actually invest in a company for the long term to make money. When a company is publicly traded, so it's on the stock market, it is required by the SEC to release certain information about the company. That way people like you, investors, can make smart decisions. One of the things that a company is required to do is every 3 months or every quarter, it is required to have an earnings call where it releases something called a 10Q. A 10Q is its quarterly, so every 3 months, a quarterly financial statement. This statement will tell you how much money a company made, how much revenue it made, how much profit it made, how much money it lost. This is how much money it made over the last quarter that it's reporting for. But what you need to remember about the 10Q is these are unaudited statements. So these are statements just released by the company. A 10K is an annual statement released by a company. So every single year, a company is going to have to compile all of their financial data for the last year, how much money they made, how much money they lost, where their money is going, and all of that information, and they're going to compile it into the 10K. The interesting thing about the 10K is this is supposed to be a little bit more accurate because these are financially audited statements. You want to be reading the information that's on these documents. Now, if you don't want to actually read these actual financial statements, what you can do is go to a stock website like Seeking Alpha or finance.yahoo.com. I'll link these for you in the description. You can go to these websites and they're going to break down the information that's in these financial statements. So you can go there and see how much revenue a company is making, how their revenues have been growing, how the profits have been doing, and everything else, and they will list it out for you. That way you can look at the financials of a company. When it comes to doing technical analysis, that's when you're going to want to be looking at stock charts. So you can go to a website like stockcharts.com, and then you can look at different indicators for a stock. There are tons and tons and tons of different indicators out there, and so what you want to do is create a strategy that you follow, because one indicator might tell you to sell and another indicator might tell you to buy. So you need to make sure that you have your own strategy and look at the indicators for that and follow your investment goals based off of your strategy, because if you don't, then you're going to go down this rabbit hole of never knowing what to buy and when to sell, and it is going to be very overwhelming. I want to do something a little bit different today. Today, I'm going to create a checklist of the 10 steps that I would take today if I was starting over for zero and I wanted to build wealth, or I wanted to become a millionaire in my lifetime, assuming that I had credit card debt, assuming I didn't have any savings, assuming that I have other different types of debt, student loan debt and auto loan debt debt, what would I do today to start building wealth over my lifetime? So the 10 steps that I'm going to be going over, and I'll go over each one of these in detail in this video, is number 1, understanding the wealthy mindset and understanding the money rules. Number 2 is work to save my first $2,000. Number 3 is work to pay down my high interest debts, like my credit card debts. Number 4 is building a financial system, something like my 75-15-10 plan. Number 5 is managing my non-credit card debts, my lower interest rate consumer debts. Number 6 is making the decision of should I be paying down my mortgage versus investing my money. Number 7 is what do I do to get my cash flow exceeding my expenses for my investments? Number 8 is work to double my income. Number 9 is build my asset protection systems. And number 10 is how do I leave a legacy on this world? So let's go through each one of these steps one by one in this checklist, starting with number 1, understanding the money mindset and rules. On the simple side of the mindset, most of us, myself included, grew up with some sort of negative association with money. And if you grew up hearing things like, we can't have money, rich people are evil, money is bad, we can't afford nice things, what do you think you're going to think about money when you turn 25 or 30 years old? Well, if you grew up with all this negative association with money and you didn't go out of your way to start learning about money, chances are you are going to have a negative association with money, that money's bad, money's evil, rich people are bad, and that you can't become wealthy. And then when you go on to have kids, what do you think you're going to be telling your kids? Well, your kids are going to see you talk about money the same way you heard your parents talk about money. And if you grew up in a broke mindset household, your kids are going to grow up in a broke mindset household. And this is where it is very important for you to change the way that you think about money. And yeah, I know it sounds like a bunch of just fluffy stuff, but it is so important to believe that you can become wealthy, that there's an abundance of wealth in the world, and that you have the ability to achieve it. And if you don't believe that, well, I can guarantee it's going to be impossible for you. But this is where it is so important for you to believe that you can become wealthy, because the reality is there's a lot of money in the world. A central bank is producing trillions and trillions of dollars. All you need to do is get a small little sliver of the pie. That way you can build that wealth for yourself and your family and your future generations. And it is possible, but you have to believe it's possible. Let me show you. I've spent the last number of years talking about financial education and teaching financial education to people all over the world. And in the beginning, I used to think that money management and building wealth was just a numbers game. That if you make $50,000 a year, what do you need to do with your money to become wealthy? But as I began talking with more and more people, I realized that there's more to building wealth than just understanding what you need to do with your money. You have to understand the mindset. And the reason why is because if you don't believe that you can do it, you're not going to do it. You're going to self-sabotage the things that you need to do in order to become wealthy. And the thing that everybody wants is this. We want that outcome. That outcome is financial freedom. We want that cash flow. We want the wealth. We want to be rich. We could put whatever word that you want. But this is what everybody wants. We want the outcome. Now, if we work backwards, in order to get this outcome, you have to take certain actions. This is what you do with your money. This is what every other step that I'm going to talk about in this checklist is going to be going over. How do you save your money? How do you invest your money? How do you put your money to work? What actions you need to take to get that outcome. But in order to take the right actions, you have to have the right thoughts. Because in order for you to do something, you have to think how to do it the right way. And if you don't have the right thoughts to take the right actions, you're not going to have the right outcomes. And this is where what a lot of people do is they just say, change the way you think. And so how do you do that? Well, just start praying and meditating on this idea that I will become wealthy, I'll become wealthy, I'll become wealthy. And if you do that, you're going to be able to manifest wealth. But if you think that, but you have these subconscious thoughts, like these kind of pre-thoughts that in the back of your mind, you have this little voice saying, well, I know I'm just saying this so I can say it because that's what the person on YouTube says. Just say you can become wealthy, that way you can have the action and have the outcome. That's what the people on YouTube say. Well, if you have that little voice in the back of your mind, well, guess what? This whole system becomes broken. And that's where if you want to become wealthy, it's not just about the way you think, it's about really the way you believe. And it's about changing your subconscious. Now, I'm not going to have the time in this video to do a deep dive into how do you do that. But the simplest thing that you can do, if you feel like this is something that's going on with you, which is okay, that's normal, it can be changed, it can be fixed, but you're going to have to invest in your own personal development and your self-development. Start absorbing that content. Read books, watch YouTube videos, listen to podcasts, take classes, do whatever you got to do, but you have to change the way that you think about you becoming successful and wealthy, because if you have that little voice in your head, even though you might think that you're trying to change the way you think, unless you get rid of that voice and you truly believe that you can become wealthy and that money is abundant, it is going to be impossible for you. Once you understand understand this on the mindset side, that's where you want to understand the money rules. That way you understand why it's important for you to become wealthy. Outside of the government and our central bank, there are three main entities or stakeholders that make up our economic system. That is our C, the consumers, the I, the investors, and the B, the businesses. Now, every single person is a consumer. Rich people, middle class people, poor people, everybody's a consumer because everybody's got to eat. Everybody needs clothes, everybody needs a home. So everybody buys things, that means everybody's a consumer. But most people are not investors or business owners. So now, let's understand a little bit how this economic system works, because the way that our economic system works is that you and I go to Chipotle to buy things. What does that mean? We are consumers. We are going to this business, which is Chipotle, to buy a bowl of Chipotle and get that extra guac. So now, you as a consumer are taking your money and you're giving it to Chipotle, and in exchange you get a Chipotle bowl, but the person that benefits financially is of course the owners of Chipotle. Now, who are the owners of Chipotle? Well, these are the investors in Chipotle. Anybody can be an investor in the Chipotle stock, but the people that make money when you spend money at Chipotle and buy that extra guac is, of course, the Chipotle business and the investors. But what you have to also remember is that in today's economic system, we have this thing called inflation. And inflation isn't something new. Inflation has been around for decades, but inflation hurts consumers. Because now when you want to go out and buy something, it costs you more dollars, right? You want to go to Chipotle, it's going to cost you more money today than it did 5 years ago because extra guac is more expensive, that bowl is more expensive. That is inflation at work. So now, in this economic system, we have inflation. We know that inflation has happened and it will continue to happen in the future. Now you might say, Jaspreet, how do you know that inflation is going to still exist in the future? Well, even if you go to the Federal Reserve Bank, they have a page saying that they aim for 2% inflation. The Federal Reserve Bank wants inflation. The government wants inflation. And the reason why they want inflation is because it helps keep spurring our economic system. So now what does inflation do? Well, inflation means that you might be making a little bit more money from your job because, well, incomes have risen over the last number of decades, although it hasn't risen fast enough with the higher cost of living, but that's besides the point of this video. Inflation means now you make a little bit more money, but now when you want to go buy the Chipotle bowl, or when you want to go shopping, you want to go on a vacation, you want to buy a home, whatever, you want to go spend money, it's going to cost you more money. So now more money is going into the hands of the businesses because you got to spend more money as a consumer. So inflation hurts consumers. But what happens now when businesses make more money? Well, they're making more money because they got to charge more money for their products, but that also benefits the investor because more money is going into the hands of the businesses, and the investors are what own the businesses. This is why this financial education is so important. It's because everybody's a consumer. We're all taught from day one how to be a consumer, how to buy things, how to like things, how to shop for things. But this is where the wealth is built. Now, you don't have to go out and start a business. You don't have to go out and start the next Chipotle, but every single person needs to be an investor because that's where the wealth is built. Not just that, our economic system is designed to benefit the investor because guess what? Our economic system is designed to create inflation. So now, if you don't understand this, you're not going to see why it's so important for you to change out of just being a consumer to being an investor. But the investors are the ones that benefit when our economic system happens. And our economic system is going to continue to happen. Inflation is going to continue to happen. Inflation is going to continue to hurt the average person while making certain people, like investors, richer, which is why you want to be an investor. But that's not all. Remember, our economic system is designed to benefit the financially educated. And as an attorney, who's not your attorney, what I can also tell you is that our tax code is designed to benefit the financially educated. Now, how do I know that? Because guess who gets the biggest tax breaks and the lowest tax rates? It's not the consumers who are just earning money from their job. It's the investors and the business owners. Because guess what? If we just assume now these are people who earn money from their job, if you earned $1 million working as a doctor or as a CEO versus you generated $1 million from your investments, who do you think is going to keep the most money at the end of the day? Now you might think, wait, $1 million as an investment and $1 billion from your job is the same thing. Well, maybe it is to you, but it's not the same in the eyes of the IRS or the tax code, because according to the tax code, you get to pay a lower tax rate on those taxes as an investor than $1 million from a doctor. And maybe you get more tax breaks as an investor versus a doctor. As a doctor, you might have to pay half of that money in taxes, which means you might be left with $500,000. As an investor, you might be paying 20% to 0% of the income in taxes, depending on how you invested your money and what types of investments you have. Meaning, after that whole tax bill, you might be left with $800,000 to $1 million. $800,000 to $1 million is a lot more than $500,000 after taxes if you earn that money just as an employee. Now again, not everybody has to go out to be a business owner, but this is why it is so important for everybody to understand these money rules. That way you can at least become an investor, because investors get to win in this financial system, not only because you have the ability to earn more money, but because you also have the ability to take advantage of the tax code, because the tax code is designed to benefit the financially educated, just like how our economic system is designed to benefit the financially educated. This is why you want to start with understanding the mindset and the money rules, and now we get into the practical side of what do you actually do with your money to build wealth, which is checklist number 2. Now that you understand that you can become wealthy and why it is so important for you to become financially educated, it's time for you to take practical steps with your money to actually become wealthy. And if you don't have any savings, the very first thing you got to do is save $2,000 to protect you against an emergency, and put this money aside in a separate bank account that's there not to buy a home, not to buy a car, not to buy something from Gucci, but to protect you against an emergency. And the reason why you need to have this $2,000 put aside is because life happens. It happens to every single one of us. Maybe you get pulled over by a cop. Maybe something happens to your kid. Maybe something breaks with your car. Life happens. It happens to every single one of us. But if you're not prepared for this with some sort of financial cushion, you're going to be the one that pays the price, because now either you're going to have to sell out your investments, which you didn't want to do at that time because the markets just happen to be crashing when that emergency happens, or maybe that means you're going to have to go into credit card debt, which is actually what most people end up doing when an expense comes up and you don't have the money for it. Now, not only do you have to pay $2,000 to cover the broken water heater, but then you're gonna have to pay an additional $800 in interest on your credit card to pay it back because you weren't prepared. And that's why you wanna be prepared, because life happens, we know this. And the wealthy are working to be prepared. So the first thing that I'll be doing now in the practical steps is work to save $2,000 as fast as possible, and do whatever I need to do to save the $2,000 and put it aside in a separate savings account. And this is not money that I'm going to use to spend at Gucci. This is money that's there to protect me against an emergency. Once I do that, then the next thing that I'm going to do is work to pay off high interest debts like credit card debts. And the reason why I'm going to do this, before I think about investing my money, before I think about putting my money in the stock market or doing any of that other stuff, is because I know that these credit card companies, if I have credit card debt, is costing me 15, 20, 25, 28% a year in interest, versus the historical stock market return over the last century is something like 10% a year. So now, if I can work to pay down my credit card debt 1 year faster, I'm going to get a better return than investing my money in the stock market. Not to mention, I'm going to get a guaranteed return by paying down my credit card debt, versus by investing my money in the stock market, I'm hoping to get a good return. And this is where it is so important for you to get very aggressive here to pay down this credit card debt, because this is what holds so many people back from ever becoming wealthy. Because when you're constantly in credit card debt, you can't think about building your wealth upwards. All you're trying to do is get to zero. And that's why during these 2 steps of this checklist, you have to be extremely aggressive. That means during this phase, you're gonna have to make financial sacrifices. That means maybe you gotta stop eating at restaurants. Maybe you gotta cancel that vacation. Maybe you gotta live in a smaller apartment. Maybe you're gonna have to sell that BMW. And these are financial sacrifices that are very hard to do, but until you get committed, it is gonna be extremely difficult for you to get to even zero on your wealth scale. I want you to get to $1 million and beyond, but you can't get to $1 million and beyond until you at least get to zero. And if you're stuck here, you're just running in circles trying to get to zero. And that's why you have to get extremely aggressive. And what I like to tell people is, until you have this done, until you have your credit card debt paid off, and until you have this $2,000 saved up, you shouldn't even have a Netflix subscription. Now you might say, Jaspreet, what the heck are you talking about? Netflix is $15 a month. What difference is that gonna make of me saving this $2,000 and having this credit card debt paid off? Well, what you have to remember is the real cost of Netflix isn't the $15 a month that you gotta pay. It's the 2 hours of your life that you're investing into Netflix, when you could be using that time to learn more about how do you earn more money, how do you pay down your debts, how do you build your financial education, how do you build a business, how do you improve your career, how do you get a different certificate, how can you improve where you are financially. And if you don't have these 2 things done, you are in what I like to call the financial danger zone. And if you are in that financial danger zone, you should not have the comfort or luxury of sitting there watching Netflix when you are paying 25% a year to the credit card company. Because that 25% a year that you're paying to the credit card company is making them rich at your expense. And I want want you to make yourself rich instead of them rich. But in order for you to make yourself rich, you got to make those sacrifices to stop making the credit card company richer, and you got to have this $2,000. That's why I'm so passionate and aggressive by these two things, because if you don't have this, you're never going to have the opportunity to ever build wealth, which is why you need to get very aggressive about this and work to pay down the credit card debt aggressively, get rid of the Netflix, spend your time and spend your money figuring out how you can get out of the system. That way you can at least get to zero, because once you get to zero, now it's all about how do you build upwards. So now that we got this done, let's move on to number 4, which is now building a financial system for your money, following something like a 75-15-10 plan. Now, after I work to pay down my credit card debt, this is where I need to give every dollar that I earn from here on out a job. I didn't need to do that before, because before, every time I had an extra dollar, either I'm going to work to save that $2,000 or I'm going to use that extra dollar to pay down my credit card debt. Now that I've zeroed out my credit card debts, now that I have a couple grand in the bank, this is where I have a little bit of financial cushion and I can use my money a little bit more strategically, and this is where I want to be proactive, because I know what wealthy people do is they have a plan for their money before they earn their money. But what everybody else does, what the majority of people do, is they make money, they spend their money, and then they wonder where all their money went. No more of that. And this is where I would want to build a financial system, something like a 75-15-10 plan, which says for every dollar that I earn from here on out, 75 cents is the maximum that I can spend, 15 cents is the minimum that I'm investing, and 10 cents is the minimum that I'm saving. Now, the whole point behind this is this savings money is there to protect me against an emergency. This investment money is there to make me wealthy. This spending money is what I use to look rich. This is what I use to eat. This is what I use to pay for my home. This is what I use to pay for my car. This is what I use to pay for everything else, all the things that are not really there to make me wealthy. These investments are there to make me wealthy, and this investment is not money I'm using to buy a down payment for my home that I want to live in. These are true investments, and this 10 is my savings cushion to protect me against an emergency. Now, the first question that I always get when I talk about this is, well, Jaspreet, should this be gross income or should this be net income? Should this be my pre-tax income or post-tax income? And the thing that I like to say here is your investments are what's going to make you wealthy. The more money you invest, the wealthier you're going to become. But you have to just get started. Because if you have no investments right now, just get started. Start with your pre-tax income. Start with your post-tax income. It does not matter, but you got to get started. You want to invest more aggressively here. That way you have more money to invest. And so this is where you don't want to necessarily get caught in the nitty-gritty of things, but just get started. If you can't start with 75, 15, 10, start with wherever you can, and then keep working towards 75, 15, 10 of every dollar that hits your bank account. And then maybe you can be even more aggressive with your investments. Maybe you work to make this 70, 20, 10. You do what's right for you, but remember, the more aggressively you invest, the more wealth you'll be able to potentially build, because now you're putting more money aside into your investments. Now, I'm not going over just yet where I'm going to be investing money. I'm going to be saving that in the coming steps of this checklist. You'll see just why. But the first thing that I want to do is I want to create this funnel, this system where I know my money is being separated. I know that this is the max that I can spend. This is the minimum that I'm investing. This is the minimum that I'm saving. And ideally, you're going to create 3 different bank accounts, because now you don't want to accidentally spend this money or spend this money. So create 3 different bank accounts. That way when you get paid, your paycheck goes here, and then you have an automatic pool of this money that goes into a different account and a different account. So you have 3 different bank accounts, and most banks will do this for you for free. This way now you know which cash is supposed to be there to make you wealthy, to invest for you. You know which cash is supposed to protect you against an emergency, and you know which cash you're supposed to use to buy that extra guac. Now, for those of you who are interested in investing, I want to give you a little bit of a resource, because my team at Briefs Media, which is the company that I run, has a free newsletter called Market Briefs, where every day my team is working to break down what's happening in the financial news. It's a super fun to read newsletter. You can read it in less than 5 minutes every morning, and you'll get a daily breakdown of what's happening in the economy, the housing market, the stock market, crypto, and the global economy. It's completely free. So if you'd like to learn more about that and get Market Briefs, I got the link to where you can learn more and join down in the description below, or you can go to briefs.co/market. Now, we've gone through the first 4 parts of this checklist. I got the mindset and the rules down. I saved my $2,000, I paid off the credit card debt, and now I have 3 different bank accounts, 75, 15, 10, that I'm following with this financial system. But remember what I said in the beginning part of this video, which is that I'm assuming that I have other loans as well. Student loans, auto loans, other things like that, those lower interest rate consumer debts. Let's talk about now how I would manage that debt right now for me personally. The way that I would go about this situation is I would continue following 75, 15, 10. But instead of taking this 15 and putting this money into the stock market, I would take this money and use it to pay down those low interest rate debts except my mortgage. So I would use this money to more aggressively pay down my student loans, to more aggressively pay down my auto loan, and whatever other lower interest rate debts that I have. Now you might be wondering, but Jaspreet, you said earlier that the stock market has averaged 10% a year, but some of my lower interest rate debts, like my student loans, are 6 or 7 or 8%, and my car loan is 6 or 7%. Isn't that 10% return from the stock market higher than these lower interest rate debts that I have? Yes, but you got to remember that stock market return is an average. It's not a guaranteed return. And if I'm trying to figure out how do I build the most wealth, I want to go after the guaranteed returns first before I now start putting my money to grow into the markets and other places like that. And so what I would do in this situation is use this money to pay down my auto loans, to pay down my student loans, and get out of those expenses, because that's also going to give me a little bit more breathing room, because when I stop having that money leaving my account, well, now I have a lot more financial cushion, and I want to make sure that I have the financial breathing room and a little bit more of financial just space to do whatever the heck that I want. Which is why the first thing that I would do is pay those things off. Now, ideally, you're going to be more proactive with these things. That you're not going to go out and finance a car that you can't afford. You're going to go out and buy a car with cash, even if that means you don't get that BMW. Now you're driving a Toyota Corolla a little bit longer, and maybe the Toyota Corolla has some dents on it, but now you don't have to worry about those payments. And maybe that means you don't go into student loan debt. Maybe that means you change the way you go about college, you go to a cheaper college, or maybe that means you work through college. Whatever that might mean, ideally, you're going to change the way that you get these debts so you don't have to do this, because your investments are what's going to make you wealthy. And you want to start investing your money as soon as possible. But if you have a whole bunch of debts and expenses, I would want to get rid of those debts, those consumer debts, the things that are not making me any money, as fast as possible, because I know that 5, 6, 7, 8% that I'm paying to them, well, if I pay that off a year early, that's a guaranteed return, versus the 10% of the stock market isn't. This brings me to number 6 on the checklist, which, if you are a homeowner, is should I pay down my mortgage or should I invest my money? Or the alternative, should I buy a home or should I invest my money? So let's dive into that one. Now, if you remember what I said just a minute ago, when it comes time for me to use this money, the first thing I wanted to do myself is I want to pay down my student loans, I want to pay down my car loan. I did not talk about the mortgage. The mortgage is a little bit of a separate question because, well, mortgages can be a little bit tricky. Because while I don't consider my home an asset, I do understand that there can be equity built in that home by paying down that mortgage. And now sometimes some of you might have a much lower mortgage rate on your home. And this is where the question can be a little bit more different. And so now, if I was answering this question for myself of should I pay down my mortgage or should I invest, the first thing I'm going to ask is, what is the interest rate on my mortgage? If my mortgage is sub 5%, it's going to be a different answer than if my mortgage is above 5%. Because if it's sub 5%, well, now I have a better likelihood of investing that money in the stock market or something and beating that return. And even if I didn't put that money in the stock market, well, I could put this cash into a high interest savings account and I can generate 4.5% to 5% a year in interest from a high interest savings account and use that money to pay this down if I have a 3.5% mortgage. So that's the first question that I would ask. Second question that I would ask myself is, what is my risk tolerance? Am I somebody who wants to just live financially free and just be comfortable, or am I somebody that wants to live a little bit bigger? Now, for me, I have a little bit of a higher risk tolerance. I don't have the highest risk tolerance, but I have a little bit of a higher risk tolerance, and I have bigger financial goals. So for me, because I have the higher financial goals, I know that I don't just want to be comfortable. I want to have the ability to build more extreme levels of wealth. I'm going to have to take different types of risks, and I have to do different things with my money, which is why for me, especially if my mortgage is under 5%, I'm going to be more aggressive with my investments as opposed to just paying down my mortgage. Now, if my mortgage is 6, 7, 8%, now it's a little bit of a different question, because now maybe I'm going to pay down my mortgage a little bit more aggressively while also investing my money. I want to be investing my money, whether it's in my own business, whether it's in stocks, whether it's in real estate. I want to be investing my money, but this is where now understanding, well, kind of where the mortgage is going to change how I play this game. If I have a 2.5% or 3.5% mortgage, I'm going to continue paying the mortgage and I'm going to be investing my money other places as fast as possible. Now, the other thing that I would like to talk about here is, for me, Ideally, if this was an ideal world, I'm going to go out and buy a rental property before I go out and buy my own home. That's what I did. I became a real estate investor before I even thought about being a homeowner. But now, if I was in a situation today where home prices are extremely expensive and I'm trying to think about should I buy a home or should I go keep renting and investing my money, well, the key question that I would want to ask here is what is the more affordable option for me? Because I don't look at buying a home as this ability to build huge generational wealth and build my wealth, because I want to build my wealth from rental properties, I want to build my wealth from my stocks, and I want to build my wealth from businesses that I build or own. I don't want to build my wealth through paying down my home. I know that's what a lot of people like to talk about, but that's one of the worst ways to build wealth or build generational wealth. And if you don't believe me, ask any wealthy person how they became wealthy, and they'll tell you they became wealthy because they invested their money in stocks, or they became wealthy because they invested their money in real estate, or they became wealthy because they built a business or invested in a business or something along those lines. They don't say that they became wealthy because they paid down their home. So I'm not saying being a homeowner is bad, just understanding how that plays a part in your investment portfolio. And this is where now, if I'm thinking about the home buying question, it's not really should I buy a home or should I rent a home, it's what's going to give me the ability to continue investing my money into the real things that's going to make me wealthy. Stocks, real estate, my own business, or other businesses. What's going to give me the ability to do that? If I can own a home and I can keep doing that, fine. If I can't, then I'll keep renting. The key is to be able to live wherever you can afford. That way you have the money to buy the assets that will continue paying you, that will continue making you wealthy, instead of just stretching so thin just to own a home. And the funny thing is, well, I used to be a licensed realtor. I still am, but I don't work as a realtor. But when I used to work as a realtor, every sales training talks about how now when you're talking to a buyer, what are you saying? You're telling them that they're buying this big investment, the biggest purchase of their life, the biggest investment of their life. And when you sell this home as an investment, it's much easier to get you to buy a little bit bigger, to buy a little bit nicer, because you think it's this nice investment. And then what it ends up being for the majority of people is a big money pit. You're just sucking money into this home and you no longer have money to invest because you just think that you're building wealth by building equity in your home. But if you really want to build wealth, it's not just by building equity in your home, it's by building equity in the stock market, rental properties, and through businesses that you own or invest in. That's where the real equity is that will make you wealthy, is not the home that you live in. Now sure, is that equity in your home that you live in good? Yeah, but I would rather have the equity in the stocks, rental properties, and the businesses than just the home that I live in. So understanding that question and making sure now that whatever I do is not going to sacrifice my ability to keep investing my money. Moving on to number 7 in this checklist, which is now getting my cash flow to exceed my expenses. So now let's go back to the 75-15-10 diagram. When I actually start investing my money into assets like stocks or real estate or into my own business to build wealth outside of my 401k, by the way, if your 401k is giving you a match, continue doing that earlier because that's kind of like free money you're getting from the company. But now when I'm thinking about where I want to invest my money, I like to generate cash flow. And by cash flow, that means that I own something and this thing pays me every month or every quarter, every year just for owning it. That's what I like. Now, not everybody likes cash flow because when you generate this type of cash flow, you have to think about taxes. Because every time you get paid, you have to think about taxes. Now, of course, when you make money from your investments, you qualify for certain tax deductions or tax breaks or lower tax rates because that's what the tax code says. However, you still have to think about taxes when you generate cash flow. Versus the alternative is investing your money for appreciation, which is I go out and I buy this investment for $100 and then I have to hope that it goes up in value to $200. Now, neither one of these is right or wrong. You just have to figure out what's right for you. Personally, I like investing for cash flow. That's why the bulk of my investments are cash flow investments. So now, where would I be putting this money? Either I'm going to use this money to go out and buy rental properties that's going to pay me with cash flow, or I'm going to use this money to go out and invest in dividend-paying stocks or dividend-paying funds that are going to pay me with cash flow, or I'm going to use this money to go out and invest in my own business. So depending on where I am in my career or what I'm interested in or what I want to do, that's where I'm going to go out and invest my money. But the goal now is for me to generate this cash flow and then take this cash flow that I'm generating and keep investing it back to get more cash flow. If I invest in dividend-paying companies or dividend-paying funds, I'm going to keep investing into it every single week. Every time I get paid, I want to be as aggressive as possible. I'm going to try to do more than 15 if possible, and I'm going to keep investing my money to generate this cash flow. In the beginning, the first couple of years, you get nothing. It's peanuts. It makes no difference. But the goal and the real key to becoming wealthy here is you keep investing your money more and more aggressively as you generate more money. That way you can generate more cash flow with every dollar that you invest. And then when my cash flow makes money, when I get paid with those dividends, I reinvest those dividends so I have more money going on to buy me more cash flow. So every time I make money, I'm buying cash flow. When my cash flow pays me with cash flow, I'm using that to buy more cash flow. And then understanding the decade of sacrifice. It's understanding that building wealth is a long-term game. And the way the decade of sacrifice works is I'm going to be working over this decade to spend less and earn more. That way I have more money to invest like crazy. Because if I can stick with it for a decade, I'm going to be in a completely different financial situation in 10 years. And in 10 years, I know that if I stick with that, I'm going to have some significant cash flow coming in. And my goal is to stick with it until my cash flow can exceed my expenses. Until my monthly cash flow can exceed my monthly expenses, I'm going to keep reinvesting this money. I'm going to keep being aggressive with this cash flow because this is the goal. When I have enough cash flow coming in from my dividends or from my rental properties, well, now I am financially free. And that's why I want to be aggressive until then. And yeah, it is going to take time. It's not going to happen in a year. It's not going to happen in 2 years. It's not going to happen in 5 years. It could happen in 10 years, depending on how aggressive you are and where your expenses are. But this is where now it is important to stay aggressive here to keep reinvesting the cash flow. And for me, I'd keep doing that until my cash flow can exceed at least my basic expenses. Maybe not my lavish expenses, but at least my basic expenses, because then that's going to give me the opportunity to be more financially free. This brings me to the 8th part of this checklist, which will help me get to the cash flow exceeding my income part, which is how do I double my income? And how do I double my income as many times as possible? That way I can keep earning more money. Now, that might sound a little bit unrealistic, but this is where I want you to start being a little bit unrealistic. Because if you really want to become wealthy, remember what we talked about here, you have to believe that it's possible for you. And the people that can actually become wealthy, well, guess what? They believed it's possible for them. And this is where now I want you to think. If you're making, let's just say $50,000 a year, what would it take for you to earn $500,000 a year? To add another zero to that. Now, as soon as you hear me say that, you might say, Jaspreet, what in the world are you talking about? How in the world do you expect me to go from $50,000 to $500,000? But if I said you had to figure out how to do that, what would you do? Maybe you'd start watching some YouTube videos on how to earn more money. Maybe you'd start reading some books on how to earn more money. Maybe you listen to some podcasts. Maybe you take some classes. Maybe you start trying things. And now you start experimenting on how to increase your income. And guess what? There are ways for you to turn your annual income into your monthly income. People have done that. And then there are ways to turn your annual income into your weekly income. People have done that. And there are ways to turn your annual income into your daily income. People have done that. Now, of course, is that very likely? No, but people have done that. And this is where you don't have to kill yourself and drive for the rest of your life trying to just increase your income. But if you really want to get to that wealth sooner rather than later, if you want to increase your cash flow, you got to put some effort into here. How do you increase and double your income faster? And there's a lot of education out there on how to do that. Now, there's going to be a lot of mistakes made by you. Every single person goes through that. I went through that multiple times. There's going to be a learning curve. There's going to be that hurdle. There's going to be that time involved. There's going to be that stress involved. There's going to be that risk involved. That's all part of the game. You can't avoid that. There's no like, oh, you just do this, this, and this to double your income. That's not what I'm talking about, okay? That's a bunch of other people on the internet that are selling crap on how to just make $10,000 a month doing nothing. That doesn't work. What I'm talking about now is how do you actually work to increase your income? How do you increase your skill set? How do you sharpen your skill set? How do you increase the value that you can provide somebody else, your business or whatever, to earn more money? And this is where you want to be starting to invest into that as well. Maybe that means you get a career change. Maybe that means you work to get a certificate. Maybe that means you work to get a job change. Maybe that means you start a side hustle. Maybe that means you start a business. You got to figure out what's right for you. And one of the funny questions that I get asked is, Jaspreet, what business should I start? I don't know. I don't like this idea of just going out and doing X, Y, and Z, going out and doing Amazon fulfillment or doing e-commerce or doing whatever people talk about on the internet, because that's not a real business to me. And there's a lot of failures involved with that. And you're just kind of just following somebody else's system. That to me is not entrepreneurship. Entrepreneurship is innovating, creating something, building something that you are passionate about, where you believe that you can actually impact the world. And you got to figure out where that value is for you. Maybe you don't start a business. Maybe you don't start a side hustle. Not everybody should be an entrepreneur. Maybe you're going to work in your job. Maybe you're going to work in your company. Maybe you're going to ask your boss. Maybe you work to get a different job or a certificate or something. But you got to work now to increase your income, to increase the value that you can provide as a person. That way you can earn more money. And now as you earn more money, you continue following that financial system. If you keep investing your money more aggressively, well, guess what? Now you have more money going to buy you more cash flow. You have more money buying you more investments. That we can get to that wealth number even sooner. This brings us to point 9 of the checklist, which is asset protection. As you start building your wealth, you need to start thinking about how do you protect your wealth. That means now talking to the right people, talking to the right advisors. That means on the legal side, how do you have lawyers there to protect you? Because when people realize you have money, they're going to try to take their hands, put it in your pocket, and take some of the money for themselves. I told you earlier in this video that I started investing in real estate earlier on. And when I started investing in real estate, I had no idea what I was doing. And as I started getting involved with real estate, I had a not so good tenant in my first property. And the not so good tenant ended up suing me. Well, actually, she sued my real estate company. And the reason why she sued my real estate company was because she claimed that the bathtub was too slippery when the water was on. True story. And she wanted to go after the quote unquote rich landlord for some money by getting one of those free attorneys. I had no idea what was going on. I was a young kid. I think I was 20 years old or 21 years old at the time when the lawsuit came in. And I didn't really know how to handle it. But I had insurance. Insurance worked to settle the claim, and the other party didn't actually win anything because we found out that they didn't actually slip and fall in the bathtub. They slipped and fell at a friend's barbecue. But all this to say, you want to make sure you have the right advisors, because guess what? In this world, people will try to come after you when they realize you have money. So you want to make sure you have the right legal protection there. You want to start thinking about estate planning. Even though you might be young, you want to start thinking about what happens if you were to pass away. How do you get the right estate planning in place? Talk to an estate planning attorney. You want to make sure you have the right financial guidance. Get a good tax advisor. Guess what? The IRS tax code is a tax code. It is a rule book. And you want to make sure you have a good advisor that can guide you on how to use the rule book to pay the least amount of money in taxes legally. So you want to start investing in this asset protection as you start to build that wealth. And of course, you want to think about now, how do you leave that legacy as well? How do you give back? How do you help other people? Because at the end of the day, as you work to build that wealth, you're going to have the ability to help other people, not just through more money, but also through your time. And this is very important now. As you build your wealth, as you start to fill your cup with water, how can you help fill other people's cups? Because if you have an empty cup of water, you can't give anybody else water. But as you start to fill that cup of water with water, and by water I mean that wealth here, now you have the ability to fill other people's cups of water. And the nice thing here is as you start to build that wealth, you can help to fill other people's cups of waters without really draining your cup as well. And again, it's not just necessarily through money, but also through your time and through your education. And how can you help other people? Because you want to leave a legacy and not just keep everything for yourself, because you can't take all this money with you, but understanding how you can help others and how you can leave a legacy in the world. More on the fun side, that we understand that there are different ways for you to be investing your money. Now, what you want to understand here is that the way that you make money, the way that you actually see the most success as an investor in these types of funds is not by going out and putting $1,000 into one of these funds and just letting it sit there. The way that you actually build wealth with these types of funds